they're handing out some information, and a lot of it has kind of been gone over already. But as I was doing some research, both with the realtors' websites, which has great resources for what's been going on in the state and nationally, and also the home builders' website has some great information. I have been in lending for a lot of years, and I have seen a lot of changes. My lending is in residential. It's not in commercial, but being a lender at the bank, I do sit on the board, so I do see what happens with the commercial lending. When they asked me to speak on lending for construction, my response was kind of, what lending for construction? We don't have a lot of lending for construction anymore. And kind of to bring that across to home is the fact that I look back at the bank and how many construction loans my department did in 2007 versus how many construction loans we've done this year. In 2007, we did 60 construction loans. That's not to say that we didn't do more loans for new homes. Those were just the loans that we did where we actually were giving the money out during the construction time. There's a lot of builders that would do their own financing for construction, and we would do the end loans. But during our construction timelines, which with winter, of course, everything slows down, that's a lot of new construction. This year, we've done 4. There's just not a whole lot going on for new construction. Unfortunately, a lot of that has to do with the fact that, or it all has to do with the fact that you can buy a home cheaper than you can build one right now. It is tough to get appraisals for new construction. The cost of materials have not gone down. The cost of the homes have. And it makes it really difficult for the appraisers to be able to come in with a value that substantiates the cost, which makes it very difficult for us as the lenders. Unfortunately, and I'm sure everybody is aware of this, with appraisals, the appraisers have to take home sales that have occurred in the last, ideally, 6 months. When I look at it, I expect to see 12 months because we just don't have enough sales to look at a 6-month period. And they have to base their values on what those sales have been. There is not a huge, they can't make big adjustments for new construction versus the loans that are on the existing homes, because in reality, buyers are not willing to pay those premiums anymore for new construction versus existing home if the existing home is in excellent condition. So it makes it really tough for the appraisers. It makes it really tough for the lenders. And unfortunately, the builders are paying the brunt of that. Most appraisers really try to stay away from using foreclosed homes in their comparable sales because they know that they're not a reality for what the value actually is. If they can stay away from it, they will. But in some areas, they don't have any choice because that's all that's out there. There's some communities that the bulk of their sales are foreclosed properties. And if that's the case of what's going on, then that's what's driving the market, and that's what's driving what those prices are, is those foreclosed homes. It makes it really difficult, and it makes it really difficult for the builders. There is money out there for construction. I mean, we have no problem doing construction loans. You are not going to get a construction loan if you don't have anything down. The underwriting which is the bulk of what I do, has gotten very stringent and very tight for any kind of lending, whether it's construction, new construction, or existing home. There's a little more flexibility with existing home for zero down. You still got guaranteed rural housing, which will do zero down, your federal VA, but there is no new construction with those programs. If the builder is willing to build it and then sell it so that it's complete, there's financing for it. But if the lender has to do the construction and take that risk during that time frame, there's not a lot of lenders out there that will do that anymore, because the value can shift from the time you start to the time you finish. And if they're coming in with nothing down, they're not willing to take that risk. They can't take that risk because you have to get a new appraisal when the house is finished, and now it's not worth what it was when you started. The areas have calmed down a little bit. We're not seeing the drops that we did see over the last couple of years in most of the areas. New Richmond is still, depending on the price range, you'll still see some drops. Hudson is getting much better. They've leveled off. Some areas have even increased a little bit. River Falls is getting better. If you go over the river, Minnesota is getting better. There are some pockets in Minnesota where you actually, I think as Toby had said, they're bidding against each other again. And I remember seeing that a few years ago, where there was some areas where a property would go on the market and it would sell for more than what it was listed for, because you'd have 2 or 3 people that wanted that house. You're seeing that a little bit now, but you're seeing it more with the foreclosed homes, where the lenders are fire selling these houses, and you'll get 2 or 3 people that want that home. And it may actually sell for more than what they had it listed for, because it was such a good deal. But that is bringing those prices back up a little bit, which is a good thing. Lots, I think any builder knows that the lot values and sales have kind of become non-existent. I went online with the Realtor's website to check and see what's been going on with lot sales. We used to do a lot of lot financing. I think we've probably had 3 or 4 this year. Most of them, or all of them, have been people who have come across some really good deals, and they're buying the lots and going to hang on to them, because once values come back where they can sell their existing home and build, this is where they're going to do it. And they're getting a lot for half of what they could have gotten it for 4 years ago. Unfortunately, you do not see a lot of developers coming in and buying these lots at bargain prices. Now, I did notice in Hammond, Hammond had 27 lot sales so far this year. 22 of them were to one buyer who came in and bought these lots for $9,500 a piece. Great for the developer or whoever the investor was. He got a heck of a deal. But, if the individual people maybe could get that information out to them so that they were looking down the road. But again, their disposable income plays a big part on what they're willing to do to purchase those lots and hang on to them, because they're not going to be income producing, so they've got to pay the taxes, they've got the payment on them. And for a lot of people, it goes back to their fear of what's going to happen with my job, what's going to happen, are the values going to continue to go down? Is it a good deal? It may be half of what it was 4 years ago, but maybe next year it'll be less. So they don't take that jump. I think that once we get past that and people feel more confident, you're going to probably see more individuals that are willing to buy some of those lots and when they feel they can get their home sold. They maybe aren't going to make a ton of money on it, but get their home sold so that they can turn around and build on this place that is maybe where, put their dream house up. And then you're going to see things start to turn around a little bit. But unfortunately, I think that's going to take some time. And I don't know that we're going to really see that maybe in 2012. I think we have to get through these elections. There's so much uncertainty with what's going on with all this election stuff that you have just a lot of people sitting on the fence. As far as the banks and financing for developers, unfortunately, for a lot of banks that got themselves in trouble, it was because of their lending with developments. They went out on limbs. Everything was going up, everything was selling, and the builders, the developers were all very strong, and the banks were very generous with their money. The losses that have occurred for a lot of the banks have been because of those developments that didn't go anywhere. The developers and the builders have lost everything. The banks have ended up with these lots that they can't sell. The big banks will pretty much give them away just to get them off their books, which doesn't help anybody. Unfortunately, the regulators are forcing a lot of that and not allowing the banks to hang on to these things to see when they're going to come back up. It costs the banks a lot of money to have all these assets tied up, all this money tied up in these assets that are not income producing and is just costing them money for taxes. So they consequently have to unload them, which unfortunately isn't helping anybody. So getting the banks to do financing for developers right now is probably almost non-existent. They're very leery. The regulators come in and they see that you've taken on a new development. Boy, that developer had better be very, very strong. They better have a lot of cash because the regulators are going to just rip them apart for having taken on that additional debt in a field that is so depressed right now. So it's not good news, but it's also gotten better. I do see that it's gotten better. One thing that has helped a little bit, you guys don't see it quite as much as we do, is the refinance boom. With the rates being so low and everybody is trying to get their home refinanced, the government has come out with some fantastic programs if the loan is owned by Freddie Mac or Fannie Mae. For the poor borrowers whose loan is owned by somebody else, an individual or Federal Home Loan Bank, they don't have to participate in these programs, and they don't. You can refinance your house with going up to 105% loan to value. Now, as of November 15th, that's going to change. That program is changing, and I've not seen the particulars yet, but I have seen some previews on it, and I believe that loan to value is going to go totally away. That there is not going to be any ceiling as to what that loan to value can be. And the fees that Freddie and Fannie charge on those refinances is also going to decrease. This hopefully will allow more people to refinance their homes that are underwater, get their mortgage rate payments down, give them some more disposable income, because a lot of these people, we've done hundreds of these loans already, and on average it's saving people anywhere from $100 to $300 a month if they can get their house refinanced. Hopefully, for a lot of these people, or for some of these people, they're going to turn around and use that disposable income to maybe buy that lake home, or buy that lot that they've been seeing for when things turn around and they can get their house sold and they can build that home that they've been wanting to for so long. And there's a lot of people that are doing that. The purchases that we see coming through are for not so much the lots yet. Again, I think people are really scared because that's something that right now they can't enjoy. It's not like a lake home that they can go to and sit on the lake and fish. The lots just are going to cost them money, and they're going to hope that down the road that they can do something with it. But I think as individuals out there in the community, if the word can be gotten out to a lot of different people that now is the time to buy those lots, because when could you buy a 2-acre lot for $9,500? You know, and the average in New Richmond is probably between $12,000 and $15,000 for a 2 to 3 acre lot. I mean, that's unheard of. Totally unheard of. So the opportunities are there for the people that have got the money and are willing to invest a little bit and are willing to take some risk. The lending is there. The money is there as long as you've got good credit, you've got some money to put down, and you've got a good job. You know? When I started, your normal was 28 and 36 for your ratios. 28% of your income for housing, 36% of your income for your overall debt. Over the years, I saw that go to stated income. Nothing down. You could lie through your teeth and get a house. Unfortunately, during that time, as things were starting to bubble on that and blow up, I had people that came into me to see whether or not there was anything that we could do to get them out of the loan that they were in on some of these negative AM deals where, you know, they didn't even have to make the payment to cover the interest, and it was going up on them. And they had W-2 income. Their W-2 income couldn't even make the house payment. And they had bought this house. Now, for some people, it's like, did you not realize how much your payment was going to be versus your income? But that's past us, and to be real honest, the foreclosures that we're seeing in our institution, our delinquencies, strictly has to do with jobs. People have lost their jobs, or their income has been cut so drastically that they can't afford to make their payments. We do have some that have just flat out decided that they're upside down and they don't want to make their payments, and they've walked away. And of course that hurts everybody, because you get the property back, you're selling it again, it's going to Freddie Mac or Fannie Mae, and they have to get rid of these properties, so they're selling them for a lot less than what they're worth, and that the cycle just kind of continues, because that's what the appraisers have out there to use, is those properties. Okay?